Today, we're talking about fundraising quadrants. What are they? How do they impact you? And ultimately, where are you as a founder trying to raise capital, whether that's debt or equity, and exploring what your actual options are given where you are in these quadrants. So before we dive in, this is a highlight on where you might end up being. And we're going to give you specific criteria as to which quadrant you qualify for, and then what are the capital options available to you based on the quadrant that you are in. So why am I qualified to talk about fundraising? Well, my background, built and sold multiple companies. I've had 4 exits. I sold a technology company to Walmart called Liquid Sky. I've raised over $145 million as a founder, operator, advisor, investor. I now help founders navigate their capital options. It's what I do every day, work with countless amount of clients, helping them navigate where their capital can come from, how to get it, and then introducing them to the right capital partners. So let's go ahead and dive in and talk about how difficult it is to get fresh capital. Founders often think of venture as their first and primary option. But in reality, there's a lot of options. So let's talk about what you actually can do to source capital that's right for you and your business. So where do we start? Well, you start with figuring out what your North Star is. So it sounds a little cliche, but bear with me here. You don't know how to get somewhere unless you know where you're actually wanting to go. And this is the question I spend a lot of time on with founders is like, what do they actually want to achieve with the business? Let's kind of go over what those North Star potential options are, and you can kind of best identify maybe where you fall in this category. Some founders are all about getting acquired, and that could be in a wide range of options from acquire to big 9-figure exits to getting acquired from strategic, maybe it's to be a part of something bigger. There's a lot of reasons to get acquired. Of course, money is also a good reason. Sometimes founders just want to generate free cash flow. Maybe they just want to, you have a good business, you love the business, and you just want to be profitable and pay yourself more. Sometimes you have a massive ego and you want to go IPO. Nothing wrong with that. That's obviously why a lot of venture capital firms back certain founders, because they want to go big, and IPO is the only way to create any kind of liquidity event when you get too big. And then sometimes founders just are burnt out and they want to replace themselves but retain the business. So you want to still be a business owner, just not a business operator. And some, unfortunately, just want to survive. You know, maybe you're still very early in your days, you haven't figured out product market fit, and you want one of all these attractive options, but right now you're just focused on surviving. So, and of course, last but not least, some people just want a lifestyle business. You want to make a good enough amount of income. Could be 6 figures, could be 7 figures, whatever it is meaningful to you. Sometimes you've got to ask yourself, maybe you don't want to have oversight from investors or board, and you just want to be able to make the choices that are appropriate to your personal life. So ask yourself, which one of these do you most align with? Because that really dictates what type of capital you should be sourcing from various different partners, whether that's venture, private equity, or debt. There's a lot of options out there, but if you're trying to grow to IPO, private equity is probably not that practical. Venture capital is going to be more practical. If you want a lifestyle business, steer clear of venture. So now you know where you want to go. Okay, so where are you starting from? Okay, so that's where we come in with the cash flow quadrants, as I was alluding to before. So basically, we have some basic criteria, and it's not 100% catch-all criteria, but it should give you a good idea of kind of where you're at. So let's first start with where most people want to be. Early stage founders, hoping for early growth, where they're growing 10% month over month or more. They have around or a little bit below $1 million ARR. And they're showing strong potential growth rate. Okay, so that's the early growth category. Then there's established growth. That means you're doing over $1 million ARR and you are growing at over 10% month over month, and you're continuing to show strong prospects of continued growth. Then there's strong but slow. And what I mean by that is you got a real business, you're making real money, but maybe not growing rapidly month over month. Maybe year over year you're growing 10 to 50%, which is awesome, great business. But that attracts a different type of capital partner than, say, established growth or early growth. And then last but not least, the struggling companies. Now, struggling companies may not be, if you're under $1 million ARR, definitely struggling. Maybe you're over $1 million ARR, but you're declining. But we're not really covering that category today. But if you're in the struggling category, your options are obviously going to be a little bit limited. So I want you to reflect on these quadrants here and think about which quadrant you might fall in. Okay. And retain that information for as we go through all the different options based on which fundraising quadrant you are in. So what paths are available to you? So you know where your North Star is, you know where you're starting from, but which path is actually appropriate for you. So let's explore the options based on the different quadrants that we reviewed. So early growth usually falls in the category of early stage venture. So call it your pre-seed or seed round or angel round or kind of friends and family, where it's still appropriate to raise maybe under $1 million or a couple $1 million. This is established growth. So you have a lot of options. This is where everyone wants to throw money at you. You built a growing, sustainable business. A lot of people want action. So then it's really about it, going back to the North Star, which is the appropriate capital option for you, being that you'll have plenty of options. So if you're strong but slow, usually debt, private equity, or strategic M&A are often the most applicable choices for a founder at this stage. And then last but not least, struggling. There's ways to optimize your business for an acqui-hire or to turn it around and start generating cash flow, stop focusing on growth and start focusing on, just milking the profits, or bringing in a turnaround organization or CEO or whatever it might be to turn things around. All right. So let's just say, you've identified which quadrant you're in. Now you know what kind of the high level capital options that are available to you. Now let's actually break down all these different options. So you have a little bit more granularity in terms of these capital options. So attracting venture. So what does it take to attract venture capital either in the early growth quadrant or the established growth quadrant? So first and foremost, growth. If you don't have any kind of level of growth, it's going to be hard to have a VC jump in and get excited about you. Now, we'll talk about growth in two different categories. One is traction. So you built a business, it's growing, things are looking good, great. There's also growth in a market. And sometimes VCs will bet on companies that have no traction. You haven't built anything yet. And that early stage idea that you all hear about, like, oh, they bet on an idea. Well, they're usually betting on a high potential growth market and usually backing you as the potential horse to win that market or to win that race. So that's how you should think about growth. If you have an awesome market you're going into that's got a lot of future potential, and or you have a great business that's already growing, at least 10% month over month. Or you're in a shiny market. So going back to the market point, like don't be in a legacy market. And something that a lot of founders don't realize is that to pay attention to is, maybe you are in a former shiny market that got previously a lot of venture capital and a lot of money went into it maybe 3-4 years ago, but maybe not anymore. And so it's something to kind of think about. Where's the money going today? So obviously 2025, AI this, AI that, you get the picture. So how can you develop something into a shiny market to make sure you're going to attract venture capital if venture capital is the right path for you? Traction and validation. So we talked about that, just picking up traction, identifying growth channels, things that you could put more money into that had you already proven and can continue to grow the business. Having a rock star team. Ultimately, a lot of founder or VCs will back the team, less so much the business or the idea. So it's important to stack your team with the best possible people. And then last but not least, how can you generate FOMO at the end of the day? So one wise strategy for fundraising is to build a relationship with a relevant group of VCs over a period of time. And then ultimately, you're actually ready to run your fundraise process, making sure there's plenty of parties involved that already know who you are before you start the process, so that you're likely to generate a bunch of term sheets, create a little bit of FOMO so that people accelerate the process and don't just sit around and kick the tire. All right, so that's venture. Let's talk about debt. So if you're in that more established growth or you're in that quadrant for strong but slow, these are the things that matter. So when you want to acquire debt, you're going to need assets. So sometimes you could be the business and the value of the enterprise value of the business that's been validated by external investors. Or you have manufacturing equipment or IP, things of that sort, things that they could collateralize and protect their downside. Because with venture, it's all about upside growth and they don't really care too much about the downside. But they do, but it's more portfolio construction. Whereas debt, they don't like to lose money. And so that you need something that potentially can collateralize. You having deep pocket investors, so having venture investors already behind you or equity investors behind you, because that means that they'll be less likely to let you fail and they'll have more money to back you in case you run into a tough spot. So again, it's protecting the downside for debt investors. Recurring revenues. They love recurring revenue because it's predictable in terms of cash flow coming in to be able to pay down the debt. Again, protecting the downside and understanding that there's enough business coming in to where whatever they underwrite you for in terms of the debt, you'll be able to pay it back. Financial history. So unfortunately, it's very hard to get debt if you're brand new, you're just getting started. Ultimately, having a couple of years of financial history opens up a lot more options. So being a little bit more on that stable, established growth or strong, but slow category is going to be more likely a fit for debt partners because you'll have a little bit more history, been around a little bit longer. And then having some big name clients. Sometimes one of the debt products is called AR factoring, account receivable factoring, which we'll talk about in a second more. But getting paid by big clients, that means the lender can underwrite the client instead of you to make sure that you're going to get paid by that client. So that's another way for them to kind of collateralize and reduce their downside risk. And of course, inventory. So if you're a e-commerce business or you're selling physical goods, they can collateralize that inventory in a variety of different ways to make it possible to give you access to working capital for your business. Okay. And then equipment, similar to going back to machinery or assets, things of that sort. What can they collateralize with the business? All right. So these are all the different types of debt. I'm not going to go into granular detail about all of them because there's plenty of information you can get from ChatGPT on all these different paths, but you need to kind of know the terms. And so I encourage you to take a screenshot of this. It's also on our website. If you want to go to Thunder.vc, click Raise Debt. We have this exact graphic on there so you can dive in a little bit deeper in terms of what the options might be. But just remember, you kind of have to be in the established growth or strong but slow quadrants to attract the right amount of debt options. Debt's just not readily available at any notable scale or accessibility if you're in the other two quadrants. So again, it's really important knowing what quadrant you're in to know which path you should be pursuing. All right, so let's talk about private equity. Okay, so private equity, if you're not familiar, you should know. You should be watching these videos with me if you don't already know what private equity is, but it's effectively a firm or sponsor that's going to buy most likely a majority interest in your company. In some cases, it can also be a minority interest, but it's more for stable businesses. Whereas venture, they're buying minority investments in a company for high probability of enterprise value increasing over time. Whereas private equity, they have lower expectations in terms of return, but they have higher expectations in terms of reducing the downside risk. So they look for EBITDA positive. You need to be profitable. You need to be printing cash flow for private equity to take you seriously and to have plenty of private equity options. So again, either on established growth or strong but slow category. Ultimately, most private equity partners want to see a path to 3 to 5x their position from 3 to 5 years after making their initial investments. That could either be by selling the company to another private equity firm. It could be refinancing them out with debt, having a predictable business and predictable revenue. This is very, very important for private equity underwriters to come in and see like, okay, you have predictable revenue. We know that over the next several years, you're going to grow by X and therefore hit our benchmarks of what kind of return potential you have as a business. So that's something important to have. They want to have less work. They want to back a team that already is working or have assets or revenues that are already predictable and working so that they're taking less risk on the business. And then how can they potentially add instant value is another way to attract private equity. Could they connect you to one of their existing portfolio companies to do a partnership and increase revenue or cross-sell? Could they bring you on to what's known as an add-on purchase where they're going to acquire you to add on and bolt on to an existing entity to cross-sell or improve their cost efficiency or increase profitability? So how could they potentially add instant value to your business? So I mentioned bolt-on. Creative deal structuring. What's fun about private equity, they can get very creative. It's not just like they come and buy you for $10 million cash and that's it. They could potentially pay you a lump sum up front. They can do earnouts. They can give you upside into the new entity. There's leverage or debt they can bring into the picture. So there's just all kinds of ways to get a deal done. So maybe you don't see the vision, but by talking to a couple private equity investors, they could potentially propose ideas for growth or profitability that maybe you're not aware of, because that's what they do all day. So it's always worth having a couple conversations with private equity when you're thinking about either M&A or a capital deal, because they tend to be a lot more creative than, say, venture capitalists or debt providers. Let's talk about planning the exit or pursuing any kind of M&A. So if you're in the established growth or one of the other strong but slow category quadrant, think about strategic value you can add in an acquisition. So thinking about M&A, maybe it's an acquire, maybe you're struggling. Like, how could you add strategic value with your team to an acquirer to add immediate value? Fun fact, engineers, most cases engineers, could add $1 to $2 million to your purchase price based on their seniority. So stacking your team with in-house engineers could dramatically increase your acquisition price. Something to always think about when it comes to an acquire. Goes to my talent acquisition plan. And then there's product expansion. How do you bolt on to someone else? How do you add more value to their existing customer base by expanding their product offering post-exit? Are there cross-sell or upsell opportunities to their customers? You guys have similar customers, or could you introduce new customers to them that they could potentially buy from? So what are the strategic values that you have to bring outside of just your traditional cash flow and EBITDA, which are pretty self-explanatory? Do you have IP that's complementary to them? Can they add to their top line or bottom line with the purchase? So when you think about doing any kind of exit, think about what is in it for them. A lot of founders, they just continue to run their business. But if you ultimately want to drive a process and you're in one of those quadrants, or you're pursuing M&A as a potential path for what you want as your North Star, then really think about, okay, who wants to buy us and why? Now, if you're profitable, printing cash, that's always a good reason, but you'll often not get the best price if you're selling based on just cash flow and EBITDA multiples alone. You want to think about how you can add strategic value. And sometimes it's consolidation, adding the ability for firms to consolidate a market. Maybe you're the platform for the first acquisition into a market that they're going to try to consolidate. That's a lot of strategic value, both pre-acquisition and post-acquisition. So really think about how you can plan the exit. So now that was a lot of different options to reflect on. So reviewing back on the quadrants that we talked about, we have early growth, established growth, struggling, and strong but slow. Really think about, which one are you in? Which is the appropriate quadrant to place yourself in? And think about your North Star, where you want to go. And then as we kind of reviewed some of those options at a very high level, which of course, if you want to dive deeper, you want to talk to my team or anything like that, reach out to us at Thunder.vc or create a free profile on our account. We could be in touch. But ultimately, it's important to have these conversations either with board advisors, your board, your investors, of discussing kind of which quadrant you're in, where you want to go in your North Star, and discussing what are the possible paths that you really want to pursue with your business. So hopefully this was helpful to you. As a quick recap, the very binary question to ask yourself is, should you be using other people's money or should you stay bootstrapping? And hopefully the content that I provided to you today and the quadrants and the definition of the quadrants will help you answer this question of, you stay down, heads down, and focused on building and bootstrapping, or do you start seeking other people's money? If you're not familiar with Thunder, just a quick recap on who we are and what we do. We are a tech-enabled investment bank for founders, by founders, helping founder-led organizations navigate their capital strategy. Companies that have used our free tools that we make available on our website for free have gone on to raise over $1.2 billion in transactions. We personally have been involved in over $200 million in transactions over the last few years. And we have a massive network of companies and funds and investors that have used our tools or are part of our network that help enrich the data to help better identify relevant parties that you should be talking to based on which capital strategy is right for you. You're welcome to use our free VC Finder tool. You're able to find our debt financing tool where it helps you identify which debt is appropriate for you. So these quadrants, we've kind of mapped this stuff out already using technology to help route you into the right direction. We also have our podcast and newsletter that we publish every 2 weeks, which you're listening to here. And of course, our services in terms of what we do for clients, which This is just the tip of the iceberg, but really helping founders navigate capital strategy. So debt, equity, or the pursuit of M&A. That's where we come in and help provide a lot of clarity for founders, even for them that, maybe you think you want to go down a certain path, you got it in your head, but maybe you got to convince your board, you got to convince your investors. You can call us in and we can put together the report that helps defend whatever strategy is most appropriate for your business. So that's a little bit about us. Of course, we have our community, so make sure to subscribe. Just go to this QR code or subscribe at Thunder.vc. Tell us a little bit about yourself, and we'll see if we can help you navigate your capital options. All the links and details of everything I mentioned are down below. If you want access to this presentation, just leave a comment, and we'll be sure to reach out to you with the link to this presentation in case you want to review it on your own time. Thank you for joining us, and don't forget to like and subscribe.
Thank you for watching today's episode. As a reminder, I'm your host, Jason Kirby. I have built and sold multiple companies with over 135 million in transactions as either a founder, operator, or investor across multiple industries. I'm currently the managing director and founder of Thunder.vc, where we help companies and founders at all stages navigate what capital to raise and who to raise it from, and help improve companies' odds of raising capital. If you need help, reach out to us at help.thunder.vc. If you like today's show, please share with your friends, give us a like or a comment down below. And as a reminder, this show is published weekly. And to get notified of new episodes and our newsletter, be sure to go to our website at join.thunder.vc. And if you sign up today, I'll send you a few freebies on how to negotiate a term sheet, how to get a free list of relevant VCs, and much more. That's it. No more shameless plugs. Thank you, and see you next week.